So good afternoon, everybody. Good afternoon and welcome. Welcome, everybody, to our 2024 Coase Lecture. From our very beginning, the University of Chicago Law School, as a professional school within a research university, has been committed to interdisciplinary scholarship. And our faculty seek to draw on knowledge and methods from other disciplines in order to expand our understanding of law and legal institutions. Now, often these interdisciplinary ideas have created whole new paradigms for understanding the law, the legal system, and even the whole world. And this scholarship often challenges, by bringing new ideas in from other disciplines, it challenges conventional wisdoms. And one of the most powerful examples of this is economic analysis of law, or law and economics. Law and economics has influenced the understanding of nearly every field of law, and within some fields, it has become the primary methodology of understanding the law. In little more than a generation, law and economics became a standard feature of legal education throughout the United States. And the principles of law and economics began here at the University of Chicago. Ronald Coase was one of the most important contributors to it. He powerfully deployed the ideas of economics to help us understand so many aspects of law. Now, I'm sure all of the students in the room are already familiar with the Coase theorem. I will not give a pop quiz. But it was published in the Journal of Law and Economics, which is published here at the law school in collaboration with the Booth School of Business, in a now highly cited article called The Problem of Social Cost. Professor Coase also made important contributions to the understanding of the allocation of spectrum rights by the Federal Communications Commission, important contributions on durable goods monopolies, the private provision of public goods, if you ever wonder about lighthouses, like that, you can go read that one, and importantly, the theory of the firm. Indeed, Professor Coase was the founder of what we now call transactions costs economics. In 1991, he received the Nobel Prize for Economics, and he was the first professor in law school to receive a Nobel Prize in economics. I believe he remains the only law professor to have received this honor. Professor Coase built a framework for us to think about fundamental issues in law, and that framework remains as influential today as it was in 1991. The following year, this lecture series was founded to honor him and to continue the type of path-breaking interdisciplinary scholarship which he did. Each year, a member of our esteemed faculty delivers the Coase Lecture on a topic of his or her choosing, designed to highlight and introduce students and faculty in our community to the interdisciplinary field of law and economics. So it's a great pleasure to welcome our 2024 Coase Lecturer, Professor Adriana Robertson. Professor Robertson is the inaugural occupant of the Donald N. Pritzker Professorship in Corporate and Business Law. She is a scholar of tremendous intellectual energy and ambition. She is a leading scholar of financial regulation and business law. Her scholarship combines a deep knowledge of the law and institutions with insightful economic predictions and cutting-edge quantitative analyses. Her work has appeared in top law reviews as well as in the most selective peer-reviewed finance journals. Her most recent scholarship, both published and in progress, includes topics such as noisy factors, when millionaires speak, what drives their personal investment decisions, and discretionary investing by passive S&P 500 funds. For all the legal and quantitative sophistication of Professor Robertson's work, her work has great contemporary relevance and impact. Leading newspapers, the Wall Street Journal, the New York Times, and the FT have repeatedly highlighted her ideas. She obtained her undergraduate degree from the University of Toronto's Trinity College, and then she obtained a JD as well as a PhD in finance from Yale. She taught for several years at the University of Toronto's Faculty of Law, where she rose swiftly through the ranks and became the Honorable Justice Frank Ikabuki Chair in Capital Markets Regulation and an Associate Professor of Law and Finance with tenure. Very happily for us, she joined our law school in 2022. Since then, she's dazzled our students in courses such as security regulation and corporate finance. She has recently been appointed co-editor of the Journal of Legal Studies. And her scholarship continues the law school's tradition of pioneering ideas in law and economics, a history that's embodied by Ronald Coase, and in this, Professor Robertson is the ideal speaker for this year's Coase Lecture. Her topic is Finance for the Common Good, and then she will entertain questions. Please join me in welcoming Professor Adriana Robertson.
Gosh, that was really nice. Thank you, Dean Miles, and thank you all for making the time to come out here today. I am delighted, I'm really thrilled to be giving this lecture in honor of the great Ronald Coase. And so I wanted to come up with a topic that befits the lecture's eponym. Now, as you now all know, I am primarily a scholar of law and finance, so it seemed natural that I would start there. Alas, I think it is fair to say that financial markets have kind of a bad reputation these days. So does finance in general, and maybe so do markets in general. But I only have 45 minutes, so I don't have time to take on all of that right now. So instead, I'm going to focus just on capital markets. Right? And specifically, I want to take some time to explain the reasons why we have capital markets. Right? Why do we have them? What's their purpose? What, in other words, is their social function? Right? Now, like I said, much to my dismay, lots of people don't seem to like capital markets, or they're confused about their function. Right? They want capital markets to serve as environmental regulators. Right? That's things like green mandates or the climate rule. Right? Or as, on the cutting edge of promoting diversity efforts. Right? A lot of that is focused on getting women onto corporate boards. Now, those things are all great. I very much enjoy breathing air. I enjoy living on a habitable planet. I am also, might not surprise you, shockingly uninterested in arguments of the form, well, women, you're just not interested in financy stuff, right? Not convincing, right? But I am not going to stand here and tell you that the reason we have capital markets is because we can use them to achieve some other undoubtedly noble and wonderful social purpose, right? Instead, what I'm going to do is I'm going to explain to you what their social function is, right? Why, in other words, on their own terms, they are serving the common good. And they're doing that without us asking them to do all sorts of other functions. They've been doing it all along, right? And they've been doing it with a little help from a whole lot of law. Right? Now, are financial markets perfect? Of course not. Right? Are there sometimes externalities or misallocations? Yeah, undoubtedly so. Are there sometimes abuses? Unfortunately, yes. Right? Like, bad things happen. It's surely true. But despite all that, capital markets, on the whole, are pretty darn amazing. Right? So let me tell you why. Now, anyone who's ever taken one of my classes knows that I love me a roadmap. Right? So here's the plan. Here's what I want to talk about. I'm going to start with a quick overview of what finance is, what capital markets are, and because law is going to feature so prominently in the discussion, I'll also tell you a little bit about what areas of law specifically I have in mind. Then we'll go through the capital market story. We'll start with the primary market. That's where people go out and raise capital from investors. And we'll talk about the secondary market. Right? This is where people trade existing claims with each other. Right? Think the stock market. And then we'll talk about intermediaries. Right? This is this whole wild menagerie of all sorts of different characters playing all sorts of different roles. But mostly we're going to focus on asset managers and investment banks. Right? Those are just the two that we have time for. Okay? And then finally, we'll talk a little bit about, well, where do we go from here? Okay? Sound good? All right. I'm going to assume you're all nodding. So before we go any further, let's just rewind for a moment. What exactly is finance? What are we talking about here? Well, the way I like to describe it is that at the end of the day, finance boils down to two things: transferring value across time and allocating risk. Now, maybe that sounds a bit abstract, so what exactly do I mean by that? Well, the most obvious example of transferring value across time, that's just borrowing and lending, right? I need some stuff today. I know I'll be good for it in 6 months. I just don't have it right now. You have some spare stuff today. You don't really need it. So you can lend it to me, and then I'll pay it back to you in the future. Now, of course, stuff is really a term of art here. Stuff, it could be money. But you can't eat money, and it won't keep you warm, and it doesn't actually do anything. All it does is sort of sit there. Right? People don't need money per se. What they need is the stuff that money can buy. Right? Money is just a convenient way to let people transfer across different kinds of stuff. What's important is the stuff. That's why we're talking about capital markets and not money markets, right? What we care about is the stuff. Okay? So the easiest way to think about transferring value across time works like that. I want an apple, you have a spare apple, you give it to me today, I promise to give it back to you tomorrow once I've had a chance to go to Trader Joe's and pick one up, and then I can give it to you. Right? Okay, easy peasy. When I'm doing that, of course, the reason I want the apple is for consumption. But I might also want it for investment purposes. Right? So maybe I don't want to eat the apple. What I want to do is I want to take the apple and I want to plant the seeds so that I can grow an apple orchard. So I say to you, look, I don't have any apples right now, but I do have some land and some irrigation and whatever other things you need to grow apples. I'm not a gardener. So what you do is you give me the apple today, right? I'm going to plant the seeds, and then in 6 years or whatever, there's going to be lots of apples, bushels and bushels of them, right? And I'll give you back like 10 apples in return for the one you gave me today. Now notice the alchemy that's going on here, right? I started with no apples, not a single one. But I have a plan. If I could just get an apple today, I could have tons of them in a couple of years' time. So what I'm doing is I'm kind of magically pulling an apple from the future to the present so that I can use it, right? And by the way, it's magic on your end too, right? Because you started with an apple that you didn't really want, right? You've had a lot of apples lately, you're kind of full, but you might want some more in the future, right? Say in like 6 years' time. Well, apples, they'll store for the winter, but they will not store for 6 years, right? There's actually just no way to keep that apple that long, right? You freeze it, but then it's only going to be good for applesauce. So by lending me your spare apple today, you can actually transfer it into the future in a way that would be impossible with just traditional storage technology. It's amazing. Okay, so that's the first thing we do, right? We move value across time. The second thing we do is we manage risk. So one way to do that is by dividing up claims, right? Let's take my orchard. Instead of just lending me an apple today, right, and I'm going to pay you back in 10 years' time, in 6 years' time, you could say, well, how about a quarter of the apples that come out of my orchard I'll give to you, right? You share in the upside, but you also share in the downside. If it's a bumper crop, right, you're going to get a quarter of a much bigger pile of apples. But if it's a bad year, right, you're going to get less. Right? So we're sharing in the up and down. Another thing you might want to do is pool risk. Right? So we know that on average, if you plant a seed, you take good care of the seedling, and you do all the things, right, you'll get a bunch of apples. But we also know that the average isn't always all that helpful, right? And you only get to live your life once. Right? So maybe we'll get lucky. There'll be a bumper crop, tons of apples, but we might also get unlucky. Right? Maybe the weather will be bad, right? Too hot, too cold, too wet, too dry, I have absolutely no idea, but whatever it is that's not good for apples might happen. And if that does, right, we're going to be out of luck. So we might say, well, look, let's still go ahead and plant the apple trees, but let's also cut a deal with the chicken farmer down the road. Right? She'll give us half of her chickens, and in return, we'll give her half of our apples. That way, if it's a bad year for apples, right, she's going to get less, but at least we'll get some of her chickens. Right? We won't be left totally empty. If it's a good year for apples, she's going to get a great deal. Right? We're just sharing the risk. We're diversifying across different things that we might do. And we can go even further still. Right? Let's just stipulate, for the purposes of this discussion, that an early frost is really bad for apples. Okay? I have no idea if that's true. In the years when there's an early frost, maybe it's a good year for ice wine. Maybe you get lots of ice wine because it freezes early and you can do whatever it is you need to do. Well, in that case, we can strike a deal with the local ice wine producer. 20% of our apples for 20% of her ice wine. A good year for her is a bad year for us, and vice versa. And so we have this reverse relationship, a negative correlation. We can hedge our risk. Right? So that's what finance is. At the end of the day, that's all we're doing. Right? And it's pretty darn amazing. So that's what we're trying to do. And then what's the last piece? Well, what are capital markets? How does that fit into the story? At their core, capital markets are a mechanism for matching people who have ideas with people who have resources. Right? I have an idea in this story. I want to plant an orchard. You have resources. You have apples. Right? If we can just bring those two together, then we can grow a whole lot more apples. Right? And we can all be better off. Right? See, so there you have it. I don't know to what extent you thought you could learn basically all the principles of finance using apple trees, but there you go, we have. All right, but finance can't do it alone. Okay? So there's a whole lot of law involved in the story. Obviously, contracts are super important, civil procedure is super important, criminal law is super important, but I'm going to focus on what I think of as the big three areas of law. So the first is securities law. What does securities law do? Well, as my students can tell you, it seems to do a whole lot of things, right? But its primary purpose is to channel the flow of capital to companies. Right? It does this in a lot of ways, but at a 10,000-foot view, the single most important way that it tries to do this is by governing the flow of information between companies and the market. And when I say the market, what I mean are investors and prospective investors. Probably the most obvious way to do this is through mandatory disclosure, but of course there are many others. So mandatory disclosure, right, you have to report on these things, you have to do it at these particular times, you have to do it in this standardized format. It's pretty clearly that's what we're doing, right? Flow of information. The second is corporate law. Right? Broadly speaking, corporate law is interested in the internal workings of corporations. Right? It structures these workings both through mandatory rules and default rules. And in particular, of course, corporate law is interested in managing agency conflicts between the owners, i.e. the shareholders, and the managers, the people that actually run the company. All right, finally, we have bankruptcy law. Right, what's the story there? Well, what does bankruptcy do? It mediates disputes between competing claimants. When there's lots of money to go around and we can afford to pay everyone, there are no disputes between these competing claimants because everybody can get paid. But when there isn't, then we need a mechanism to sort that out. We need a mediation structure, and that's what bankruptcy law is for. Right? And of course, we hope things don't go badly, but we know they might. So everything that we do happens in the shadow of what would happen if things go badly. Okay, so you can see why these are kind of the big three, and they're also sort of loosely chronological on the slide. Right? Getting capital to get off the ground, running the company once it's in place, and what happens at the end if things go badly. All right, so that's the lay of the land. We have these markets, we have a bunch of law, and it's all extremely interesting. And while I would like nothing more than to launch into a lecture on each one of these areas of law, I will restrain myself, and I will stick to the topic at hand. But you should definitely take all of these classes, because they are very excellent and very important. But here's the topic at hand. I want to stick to it, which is that it has come to my attention that not everyone thinks that finance promotes the common good. And in particular, I'm told that there are quite a few negative perceptions out there in the world. Right? So given that, I figured maybe we should take a moment to have a look at what they are. So let's start at the very beginning with the primary market. Anybody know what this still is from? If you're in my Greenberg, you know what this still is from. Right, so this is the Wolf of Wall Street. This is the IPO scene. That's Leonardo DiCaprio. Okay. So this is about companies going public, right? Which means raising money from investors in order to fund their business. Right? I am told by Leonardo DiCaprio in the feature-length motion picture that people don't find IPOs very interesting. Right? That's why he stops mid-sentence. But actually, to the extent that most people think about them at all, the perception is definitely not good. Right? It's bad stuff. Something about greedy bankers and greedy evil companies and rich people doing all sorts of bad stuff to nice people. Right? Like Jordan Belfort, like no good, very bad dude. Right? Okay. Well, so what are these primary markets? This is really the paradigmatic capital market. Right? Why is that? You have people with ideas, and you are matching them to people with resources. Someone has an idea for, I don't know, an online bookstore that's going to mail books to your house. What a crazy idea. That's never going to go anywhere. Or a service that's going to match people who have cars and some time on their hands with people who need a ride. Wild. How's that ever going to take off? Right? Or whatever other crazy idea that you might have. Now, some of these ideas are truly silly. Right? Like crawlers. Like, let's have knee pads for toddlers so that the toddlers can crawl around on their knees and they won't get hurt. Okay, very, very dumb. Didn't go anywhere. Some of these ideas are brilliant. Some of them seem pretty dicey when they start, but they're proven time, right, with luck and a whole lot of hard work and, of course, like money to get them off the ground. So that's a pretty important job. Why is it so important? Well, that's how we get innovation. If we don't let people who have ideas raise capital from external investors, then what's going to happen? Well, only rich people can start companies. Right? Only the people that already have the capital can bring their ideas into the world. That seems really, really bad. Right? I, at least, do not think that rich people have a monopoly on good ideas. Right? All sorts of people have good ideas, and those ideas can make us all better off. But of course, you need capital to turn those ideas into reality. Right? And if folks can't access external financing, then we're just writing off those ideas. That seems really, really bad to me. So that's the job of the primary market, to match people who have ideas with people who have the capital necessary, the resources necessary to bring those ideas into the world. Now notice, just like my little apple orchard, this is a mutually beneficial trade. Right? The person with the idea, let's just for the sake of argument call her the entrepreneur. She gets the resources she needs, right, to bring her project forward. That's good. She's happy. The people who put their resources behind the idea, let's just for the sake of argument call those the investors. Well, they're happy, right? They get to support a project they believe in. If they didn't believe in the project, they didn't have to invest in it. And nobody's forced to invest here. If the project does well, they get a share in the upside. If it does badly, right, they're going to be sad, but hopefully they did their research and they picked wisely. Or they hired somebody else to pick wisely, and we'll talk about that in a bit. And of course, the people the entrepreneur employs, well, they're happy, they have jobs, that's good. And finally, those of us who use the product, well, we're also happy. We get to benefit from this product that didn't used to exist, right? Like an iPhone, or an electric car, or an Impossible Burger, or pick whatever other thing that was brought into the world through this mechanism, right? It's like such a feel-good story. It's like win-win-win all around. It's like something from the Hallmark Channel, guys. This is like so like teeth-hurtingly sweet. Okay, but it's not a Hallmark Channel story all by itself. Right? It had some help from law. So there's a ton of ways that law does this, but let me just give you one example from each of the big three areas I mentioned earlier. Right, so we start with securities law. Well, one obvious example of this is anti-fraud provisions. Right? If you lie to someone or you mislead them in connection with the purchase or sale of a security, that is very, very, very bad. Right? The reason that it is very bad is because if you do that, then nobody will trust you. And not only will nobody trust you, they also won't trust the next person that comes around asking for an investment. Right? So there's this horrible externality. We don't want that to happen. So the law takes this very, very, very seriously. Right? You can be subject to civil and even criminal penalties. Do not do this. Do not lie. Do not even mislead people. Just say no. Just tell the truth. The idea here, of course, pretty darn obvious, right? Let's make sure people can trust the information that they get so that they can have confidence in the market. Doesn't mean that you're always going to make money, right? Some investments are still going to fail, but it does mean that you're going to go into those investments with the information that you need. There's the first. Second one is corporate law, right? Well, we said corporate law at a high level structures the internal workings of a corporation. And in particular, it manages agency conflicts between shareholders and managers. Okay, so it's pretty easy to see then that it's providing the scaffolding for these arrangements. Right? How are shareholders going to select directors, right, who in turn are going to select the day-to-day managers? What obligations are those directors and managers going to have to those shareholders? How will decision-making be delegated from the investors all the way down to the people doing things on a day-to-day basis? Better managing these conflicts promotes investment. Right? It's just one less thing for us to worry about, so we can focus on the project we're actually interested in advancing. And then finally, bankruptcy law. Well, we said that this mediates disputes between competing claimants, and those disputes, like we said, really only matter when there isn't enough money to go around. But of course, everything's going to happen in the shadow of that, so we can see right away why it's important. It gives us certainty about what's going to happen, and it also facilitates reorganization. Right? So that's going to increase the value of claims even when things go badly. Right? We can be fairly confident that we'll be able to salvage as much as we can from the wreckage. Okay, well maybe I've persuaded you then that primary markets, maybe they're not so bad. Right? Maybe notwithstanding Jordan Belfort, we're okay with primary markets. So maybe it's the secondary markets. That's the bad guys that we need to be upset about. Well, what are the secondary markets? Well, that's where people who've already invested their resources with an entrepreneur turn around and sell them on to a third party, right? That's what the stock market is, incidentally. And that, I am told, apparently by this meme involving Winnie the Pooh, is gambling, right? That is just gambling. And after all, isn't all of this stuff just made up anyway? Maybe it's just a bunch of made up stuff, right? And isn't it all just rigged in favor of the house, right? It's just a rigged casino, right? It is true that what happens in the stock market doesn't directly affect the company at all, right? So that is a fact, that is true. If you go out and buy a share of Apple stock, you're not giving any money to Apple, right? What you're doing is you're buying somebody else's investment in Apple from them. That's the secondary market, right? Primary is between the entrepreneur and an investor. Secondary is just between two investors. Okay, so maybe that's the problem, right? Maybe after all, these people, they're just trading, right? They aren't actually building anything. Maybe that's just a rigged casino where only the rich can play. Okay. Well, here's the problem with that view. Your primary market's going to fall apart really, really fast if you don't have a secondary market. So let's go back to my orchard. Remember, you gave me an apple, and in return, I planted the seeds, and I said I was going to harvest the apples once they grow, and I'm going to give you, whatever we said, a quarter of those apples. It takes about 6 years, I'm told by Wikipedia, to go from an apple seed to a tree that actually produces apples. Okay, so here's the problem. What if 2 years in, you realize, you know what, I really need my capital back because I've decided that I'm going to move to Chicago and I want to buy my dream home, right? Or I'm getting married and I want to plan my dream honeymoon and it's going to be like an around-the-world tour and I need lots of financing. Or, there's this fantastic charity and it's going to save us all from, AGI that could otherwise kill us, right? Whatever it is that you want this capital for, you would like to get it. We don't have any apples right now, right? All we've got are these half-grown apple trees. So I guess we could cut them down and sell them for firewood, but that doesn't seem very efficient. We could say, I guess, if we don't want to cut them down, we could say, well, too bad for you. You got to wait 4 more years. That ambition that you have in the meantime, it's just going to have to wait. That seems not great. We could alternatively, just a thought here, say, the trees are only part grown, but they're off to a promising start. Why don't you sell your claim to Dean Miles, right? He'll take the claim, he'll pay you today, so you'll get some capital back. You can do whatever you want with it. And then he'll be entitled to a quarter of the apples once we get to the harvest. Now you might say, well, Adri, this is a hokey example. Most people are not planting orchards. This is frankly kind of silly, and I'm a little insulted. But it is exactly the same thing if you swap out Apple Orchard for Apple Inc., right? It is exactly the same structure, right? Let's suppose you buy some shares of Apple Inc., right? You've invested some capital there. You would like that capital back for whatever purpose it is that you have. You could ask Apple for your investment back, right? But that would be really disruptive. Yes, of course. Apple is a gigantic company, and if just 1 or 2 of us wanted some money from them, they could just pay it out of Treasury. But if lots of people wanted it, it would be enormously disruptive, right? They're going to need to start selling factories to come up with the cash, or selling off their IP or whatever other assets they have. Corporations like Apple are, at least in theory, infinitely lived, right? That's part of what allows them to make these investments and do all the things that are great. Right? Now, I guess we could change that, right? We could say, actually, Apple Inc. is only going to exist for 5 years. Right? At the end of those 5 years, we're going to liquidate everything, return the capital to investors, and then we're going to turn around and form Apple II. You could do that, but that seems like a really terrible compromise. Right? People would still have their cash locked up for 5 years. It's kind of a long time, things happen. And it would be super disruptive for the company. So it's just not feasible to come up with a time period that's short enough to be convenient for the investors and long enough for companies to actually do the things that we want them to do. Right? It's just so much better to let investors just sell those claims on their own in the secondary market without bothering the company. And notice, the fact that investors know that they'll be able to sell in the secondary market down the line makes it better. They are more willing to invest up front in the primary market. Right? So in other words, the secondary market is what enables the primary market, knowing that they'll be able to sell later if something comes up. Okay. Well, if the primary market needs help from law, the secondary market needs all of that and then some. Here are some of the kind of greatest hits, but of course, there's so many more. There are exchanges, and we regulate those things heavily. Right? These are creatures like the NASDAQ or the New York Stock Exchange, the NYSE. We tell them what companies they can list, how they can operate. We have this cool double regulatory structure. Right? The SEC regulates exchanges, and then the exchanges regulate the companies that are listed. Right? So for example, take Apple Inc. It's listed on the NASDAQ. It has to follow the NASDAQ's rules, or it's going to get booted from the exchange. Right? But NASDAQ can't change its rules without the SEC's permission. Right? That's kind of cool. We also regulate the folks that facilitate trades. Right? These are brokers and dealers. So this includes platforms like, say, Robinhood, which we had in our little meme, or Schwab, or whatever else you might be using. We have this hugely elaborate apparatus to regulate them, things like conflicts of interest, order execution, et cetera, et cetera. And then, of course, we have our anti-fraud and disclosure rules. All those anti-fraud rules we talked about before still apply, right? As do the mandatory disclosure rules. So you have to make ongoing disclosures about important developments. Right? This allows investors to have confidence that they're being kept in the loop. They know what's going on an ongoing basis. Now, another thing to note, of course, is that these rules apply not just to the companies and their managers. They apply to anyone who makes a material misstatement or omission in connection with the purchase or sale of a security. Right? So we are doing our very best, right, to protect these investors in the secondary market, too. Okay, fine. Well, maybe secondary markets are actually pretty useful, but what about the financial intermediaries? Surely they, at least, must be the cartoon villains, right? Surely, at least, BlackRock is evil, right? Okay, well, there are lots of financial intermediaries out there, but let's just pick two broad categories: asset managers, right? Those are things like hedge funds or private equity funds, or BlackRock, which I'm told is the king of the world and is also either killing us all by not doing enough to stop climate change, or alternatively is the poster child of woke capitalism. And it seems to depend entirely on who you ask, but everyone seems to agree that they are terrible. They don't build anything. They're not even investing their own money. They're just bad, 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 bad. Okay, BlackRock is not the big bad. This is ridiculous. Whatever you might think, this meme is ridiculous. Or maybe even worse, maybe it's the investment banks, right? Like Goldman Sachs, the infamous vampire squids sucking on the face of global whatever it is, right? They're just evil parasites, right? Nefariously cheating and robbing and doing all sorts of bad stuff, right? Greedy banks burning the world around them just to make a buck, right? They're like Scrooge McDuck level evil villains, right? This is what I am told on the internet in the year of our Lord 2024. Right? Surely, I am told by the internet that we would be better off without the vampire squids and other parasites. Right? Okay, well, not really. So here's the first problem. Most people at home have absolutely no idea what a good idea looks like. Right? I sure don't. And it's pretty silly to expect them to have to learn. And even if they could tell a good idea when one was presented to them, they'd have to go out and hunt it down and find it. Right? Who has time for that? Right? Wouldn't it make a lot more sense to just hire somebody else to do it for you? Right? After all, we have day jobs and we have hobbies and we want to spend time with our friends and families. Right? I don't know. I don't really want to say to people, listen, tell your friends and family that I'd love to spend time with you, but I just can't because I have to go spend my time finding good investment opportunities. That is crazy. I am pro friend and family time, okay? Or hobbies, whatever it is, playing soccer, knitting, bird watching, pick your favorite thing. Spend your time doing that, right? If you like finding investment opportunities, by all means, don't let me deprive you, but most of us don't. And just like we would expect people to pay somebody else to make pizza for them at the pizza parlor, or fix their tooth if their tooth hurts, it makes 100% total and complete sense to pay somebody else to do this important job for you. Right? Okay, so that's problem number one. Maybe we should just like hire somebody else to do this job, just like we do for other things that are hard but also important. Problem number two is that even if you can find one opportunity, putting all your eggs in one basket is really risky. Right? You should really try to invest in lots of different good ideas. But boy, now we're looking at like a full-time job. Most people do not have the time or the inclination to go out and do that on their own. Right? So wouldn't it be great to have somebody to help? Well, that's what mutual funds are doing. Right? And low-fee index funds and ETFs, like the ones sold by BlackRock and also Vanguard and also others, are doing an enormous service. It is an enormous breakthrough in vastly improving the well-being of households across the country. Does that mean they're perfect? No. But does it mean they're evil? It means they are absolutely not evil, right? And what about, the trade-off here, right? So surely, sophisticated people, if they really wanted to, they could figure this out on their own, if they really wanted to. But less sophisticated folks, like the median investor or the median household, right, what are we going to say to them? We're just going to say buyer beware. If you can't do it for yourself or you don't want to, too bad, you're out of luck. Right? That seems awful. In fact, it sounds terrible, terribly exclusionary, and clearly the wrong answer. Right? Clearly the right answer is to let them get some help, right, from other people who can help them. Now, does that mean that we should let the foxes run the henhouse? Well, obviously not. Right? We don't. We could talk about whether there's more that we should do. Perhaps there is. But we actually do an awful lot already. So when it comes to investment companies, like, say, mutual funds, we have an enormously elaborate regulatory apparatus. Right? That doesn't mean it's perfect, but it does work remarkably well. Right? The reason mutual funds are known as the cleanest corner of Wall Street is because they actually are pretty darn clean. There's remarkably few major problems. We also regulate investment advisors, right? The people who give advice about securities for compensation. When we do that, we impose the highest standard that exists in our legal system. We impose fiduciary duties of care and loyalty on these people when they give advice. Right? They are legally obligated, in other words, to act in the best interest of their clients, and they cannot put their interests above those of their clients. Finally, we regulate broker-dealers. Right? They're subject to suitability rules when they give advice, and when a broker gives advice to a retail client, that's any of us in this room, the standard is best interest. The advice must be in the best interest of the client. And of course, lest we forget, those anti-fraud rules that we talked about continue to apply as well. Right? And in particular, they apply to all of these folks. Okay, so we've been through the players, right? The primary market, secondary market, the intermediaries. And it turns out that actually none of these guys are cartoon villains. And they're not even necessary evils either. They're just players, right? They have a purpose. They're each playing a pretty important role in our story. Right? Now, does that mean that capital markets are perfect? Obviously not, right? There are plenty of downsides. Here are some of the ones I hear about and that I too worry about. So the first is that this whole apparatus just creates a lot of waste. We've got these really smart people spending their time and talent and brain power on this, and not on curing cancer or solving climate change or creating room temperature superconductors or whatever other socially valuable thing we would like them to do. Part of that is due to the simple fact that the payoffs from working in finance are often higher than working in basic science. Right? And people follow the money. Part of that is because there's often a disproportionate payoff from winning in the capital markets, so they get this potentially inefficient arms race. Right? So that's kind of wasteful. Nobody likes waste. The second is the concern that the rich get richer. So even though it is true that capital markets allow people who aren't already rich to raise capital from external investors to bring their ideas to reality, it's still the case that, on the investor side at least, you do need capital to participate. If you don't have anything to invest, you can't invest. So a consequence of this is that the poorest are left out, right? And the folks with capital are the ones with the most scope to participate. The third is a concern about scams. Right? So yes, there are lots of rules. I have talked about some of them. There are so many more. But notwithstanding all those rules, right, scams can still happen. Right? And a consequence of that is that people lose money. right? This is obviously self-evidently bad. And then finally, there is the truly unfortunate fact that some pretty obnoxious people get rich. Right? And you can think of your favorite obnoxious jerk that made money in the capital markets. I have my own greatest hits list, but I'm told this is being recorded, so I'll just keep that to myself. Obviously, no one likes it when good things happen to bad people. Okay? On the other hand, I regret to inform you that being obnoxious is not a crime, at least not at this time. Right? Okay, so those are some of the downsides of capital markets. Well, what about benefits? Well, the most obvious is innovation, right? This is what I was trying to describe. That's kind of the crux of the common good that they're serving here. They connect people who have ideas with people who have resources. That's how these ideas get funded. So maybe there is waste, but we also get innovation. A second benefit is inclusion, right? So it turns out that about half of households in this country own equities, either directly or through some kind of retirement account. That's why former SEC Chair Jay Clayton used to talk about Mr. and Mrs. 401k. There's a whole lot of households that can participate this way. And by the way, it's very clear that intermediation actually promotes this inclusion, right? Because it's very easy to find the really rich people. We don't need intermediaries to go figure out who the people with really, really deep pockets are. You can just go knock on their door. They don't need matchmakers. Those folks also don't need an index fund or whatever to get low-cost diversification. They can just do whatever they want. Right? It's actually your middle-class households and your upper middle-class households is kind of like the big bulk in the middle. That's who benefits from the additional intermediation. So yes, the rich get richer, but also lots of other people can participate, and that's a good thing. Third, yes, there is fraud and there is other misbehavior, but honestly, on the other hand, trillions of dollars change hands in the capital markets with shockingly little misbehavior. I'm constantly sort of amazed at how well it actually all works, all things considered, right? So this is not an invitation to go out and do frauds, right? I'm definitely not pro-fraud. It is very bad. You should not do that. But it's kind of remarkable that people just hand over huge amounts of money through some website, right? And then the brokerage website takes that money and dumps it in like a share of stock or an ETF or something like that. And then you get to share in the upside, and you get a vote, like somebody mails proxy materials to you, and you send it back. It's really actually pretty remarkable how well it all works, right? So we don't want to let perfection be the enemy of the good, right? And we do have a pretty darn good thing going here. Okay, finally, we said obnoxious people get rich. That's unfortunately annoying. I guess I don't really know what else to say about that, except that lots of perfectly nice people also benefit, right? So maybe we can feel good about that. Okay, so maybe it's not so bad. In fact, maybe the capital markets are kind of serving the common good as it is, but surely we can make them even better, right? And I agree, we can. We can certainly make them even better. So I'm running out of time, so I don't have time to go into all the details. I saw you check your watch. All the details of the ways that we could make things better, so I'll just be kind of quick here. The first is that the state of financial literacy is appalling, right? Appallingly bad. And this has really, really bad distributional consequences, right? Why? Well, because for reasons that are entirely alien to me, I have been told that many women don't think that this is something that is of interest to them, right? That has bad distributional consequences. Folks that come from wealthier backgrounds are more likely to have exposure to these things earlier, which in turn gives them a level of comfort, which in turn helps them learn more, right? Also bad distributional consequences. So the obvious solution is to just teach people so that they know, so they can understand, right, what's going on here. Now, the most obvious way, right, you should just teach basic personal finance in middle school or in the high school curricula. Now, the Center for Financial Literacy reports that only 7 states require students to take a high school course with personal finance topics in 2024. That is appalling. Now, allegedly, by 2028, 23 states will be there. So that's improvement, assuming it happens. By my count, that's still less than half of the states. So there's still a long way to go on that front. Second, maybe there are some changes that could be made to enforcement. right? Some priorities might not be optimally calibrated, and we should absolutely be thoughtful about this. Finally, we should have an honest discussion of the trade-offs here. Right? I've got a couple of examples on the slide. No doubt we could talk about more. Right? So paternalism, right? More participation traded off against more risk of fraud and loss. Right? How do we optimally set that? Expanding the scope of the regulatory sphere. Right? One obvious place where we see this is in the context of crypto. Should we bring that into the securities regime? Should we not? Right? That's a trade-off. There are costs and benefits, and we should just be clear about what those are. And we should be more transparent when we do. Okay, so wrapping up, what do I want to leave you with? Listen, capital markets are not perfect. There's no doubt about that. But then again, very few things are perfect, except perhaps the University of Chicago Law School. Right? And we should not let perfection be the enemy of the good here. Right? And capital markets are just that, really, really good. Right? Our capital markets are the envy of the world. They enable mind-boggling innovation, which has improved the standard of living for everyone. They enable broad participation in the wealth generated by that innovation. Right? So we're winning on both sides. Right? We get the products, and we also get to participate in the wealth that they generate. We have this amazing thing going here. We shouldn't lose sight of that. Now, does that mean there aren't other problems in the world, like climate change or discrimination or any number of other problems? Well, of course it doesn't mean those aren't problems. Right? But it seems to me pretty obvious that there are other ways, much more direct ways, to address those problems. And we shouldn't risk disrupting something that's doing a pretty great job of a really important job to do that. Right? So in other words, don't try to make capital markets serve some kind of social goal. They're already serving the common good just the way they are. Thank you. Questions? David? Oh, you can talk to the mic, or I bet you we can hear you.
Yeah, two questions. One is you emphasize the benefits of secondary markets as liquidity providers primarily, but there's a lot of talk about them as price discovery mechanisms. And I wanted to get your thoughts on that. It always struck me that less important about price discovery, but quite a bit of the trading is price discovery trading. And so I wonder if you could address that aspect of secondary markets. The second is, I think, I'm not sure quite convinced by your argument that capital markets shouldn't also address these other social causes. And the basic claim is, well, there's other ways to do that stuff. Well, I guess the question is how you think about, so you distort capital markets a little bit by making them have common disclosures or whatever. Why not do that as well?
Okay, great. So price discovery. So price discovery is important. I tend to think of price discovery as primarily enabling the primary market too. Right, so why is that? Well, so for the folks at home, for the folks that are not me and David, price discovery, the idea here is that investors in the secondary market are going to do a whole bunch of research, and they're going to figure out what this asset is really worth, and then they're going to, by bidding one way or the other, they're going to make sure the price moves to the correct level, right? So if it's too high, they're going to short it, the price will go down. If it's too low, they're going to buy it, the price will go up, and that's how we're going to know the true value of things, right? Because traders are going to get the price there. So, I think it is aesthetically nice to have correct prices, but I think the real reason we want to have correct prices is so that we can fund valuable projects, right? So by setting prices correctly in the secondary market, people then know in the primary market how they should be investing, right? So they have a proxy for true value. By setting prices correctly in the secondary market, those initial investors who are getting that liquidity are going to get the correct payout, not too high, not too low. Right? That's going to enable them to make that upfront investment. And it's also useful for managers of those companies, right? Because they're going to make decisions based on whether their expected return from the project is greater than their cost of capital. And so they can use that price discovery as an indication of what investments they should make. And that in turn is going to lead to efficiency gains in the product side. So that's not in the capital market side, but there's positive benefits in the sort of firm investment side as well. Right? So those would be the three reasons why I think it's still valuable to have price discovery, even though it's not purely an aesthetic benefit, although I do like my aesthetic benefits as well. Okay, why not just piggyback on capital markets? Why not? It's just a little cost. So I guess a couple of thoughts on this. One, we don't know how big the cost is going to be, right? So we might think that like epsilon burden on the capital markets in order to get, many times epsilon benefits in some other market, maybe it's worth it. I kind of worry that once you start, you're never going to really stop. You end up with European capital markets, which are great, but are not nearly as good as ours. You start asking people to do too many different things, you lose sight of what you're really trying to accomplish. So this is also just the classic, organizational economics. When you have too many different goals, you can't maximize any of them anymore. So I worry about that. I worry about, well, where do we stop, right? Because after all, there are a great many really noble, really important, like I don't mean to sort of denigrate when I say noble, like I genuinely mean noble goals. But once we say yes to one, then why don't we say yes to the second? Why don't we say yes to the third? And before you know it, it's like how we ask the tax system to solve all of our problems. Right now we're going to start asking the capital markets to solve all of our problems. And I guess my claim is they're already doing something really important here. I don't want us to find ourselves in a position where we're pulling them in so many different directions. Right? We're no longer achieving the thing we really want to achieve. Yes?
I have a technical criticism of your basic analogy.
Good.
If you plant an apple seed, you don't get an apple that was anywhere near the same variety as what you planted, because apples are what are called not true to seed. Use a peach or a plum or a pear, not a pear, a peach or a plum or a cherry instead.
I appreciate that, and I do confess openly that I have no green thumb to speak of. My only real objection to that is that I am not aware of any large corporations called Cherry Co. But I appreciate that. Yes?
It strikes me that there might be an inefficiency in connecting people with these great ideas with the capital. There are tons of brilliant people in this room. If we emailed somebody in Silicon Valley to set up a meeting, it probably wouldn't happen.
Totally.
Much less so for people that are disadvantaged economically,
Sure.
who might be in the best possible position to come up with really important ideas. So I'm curious what you think about sort of lubricating or maximizing efficiency between those two.
Yeah, so I'm with you. I think that there's a problem right now, which is that our capital markets could be even better, right? So we could do even more, but the way we're going to do even more is by reducing transactions costs, reducing burdens on investors, making it easier to connect people who have ideas to people who have capital. Right, so I said earlier on, at least the system we have today enables people who aren't already billionaires to raise capital. But you're certainly right. If I cold emailed one of the big VC funds, they're not going to answer my email. So could we do even better? Of course. Yes.
2 points. One, I think for apples, you're looking for a clipping, not a seed.
Man, do you really not get the analogy? But they have a company. Okay, we'll talk about it.
And then 2, the inefficiency that you brought up about human capital allocation seems like it might be worsened by better allocation within the capital markets, well-functioning capital markets. What do you think about it? How should we address that?
Say more.
We have very well-functioning capital markets, but you also identified that perhaps one of the problems of our capital markets is folks that could be curing cancer are going to work in these capital markets. And it seems like the well-functioning of the capital markets might enhance that very problem. If we had more European capital markets, perhaps they wouldn't function as well and folks would go cure cancer. How should we think about the trade-off? Maybe it isn't, but how should we think about solving that problem?
Yeah, totally. So the way I think about it, there are 2 inputs into the project of curing cancer. There's people who have really smart brains, and there's also it's really expensive. So you need capital to do that, and it's risky, and you need to come up with ways to fund that. So there's 2 pieces to that story. So I think part of the problem is, unfortunately, there is a tension. Right? If we make there be very high rewards for succeeding in the capital markets, right, in the secondary market, this price discovery mechanism, which basically says, look, if I have a high frequency trading fund and I get there 1 millisecond before the next guy, I'm going to make a disproportionate amount of money, even though the information would have hit that market in a millisecond. And what on earth is the real social cost of being 1 millisecond slow? Nobody is making a firm investment decision on that basis. Nobody is raising capital on that basis. There's no real loss there. So that's just as pure waste. Right? I guess what I'm trying to argue is it's really hard. I don't know that anybody has come up with, but maybe we should think more about it. I don't know that anybody has come up with a way that allows you to have the innovative aspects that the capital markets enable, which I think are really, really good, without there being, unfortunately, some inefficiency that's generated too. So this kind of goes to the point about, like, is it perfect? No. Can we think of a better way to do this? I don't know. I mean, you can have transactions taxes. People talk about, let's put a Pigouvian tax on these kinds of things. You do too much of that, it's going to be a problem because then nobody's going to trade, and that's not going to be good either. And so maybe there are some things that we could do, and I'm totally open to the idea that when the purpose is to make the market function better, should we intervene? Absolutely. Of course we should intervene. Just like all the areas of law we talked about, those are interventions in the market. They're just done in order to advance the market's goal, not for some extrinsic purpose. Did I get the transaction tax part right? Maybe? Okay, close enough. I'm not a tax person. Lee.
Yeah, so my question is whether there are ways in which we can expand what capital markets deal in, and then I guess relatedly, are there any limits to how far they should be expanded? And I'm thinking here about human capital in particular. Instances where often debt financing is used, you get loans to go to school or whatever, you could instead have people that are underwritten by investors who have a share of their future earnings and so on. Should we be pushing in those kinds of directions, or is there a reason that that's a bad idea?
I think those are really cool. I will say, I think that it's great because it enables a kind of risk sharing that is otherwise really hard for people to get. Because like we said, you only get to live your life once, and you only get to have your career once, and you can have a diversified portfolio of securities, but it's very hard to have a diversified career because you only go to work one day at a time. Right? So I actually think it's really cool and really great. Obviously, there are information asymmetry and adverse selection problems that come into this, like people worry about. So is it ever going to be perfect? Probably not. But I think that it would be interesting, and there's a good scope to try. I would certainly like to try. Just like securitization, which had some, got a bad reputation and had some maybe negative consequences. They were not nearly as negative as I think some people think. It allows people to borrow more cheaply because we can parcel off the debt and sell it off into different ways. That's a type of financialization that lowered costs. I think that this could be a type of financialization that I at least think is really cool. But I think you and I might be in the minority on thinking that that's really cool and something that should be pursued. How am I doing for time? One more question. I thought I saw a hand over here. Yes, go.
It seems to me that one of the big reservations with large financial institutions isn't necessarily one of their functions, but it's that they do literally everything and they service everything from capital markets to your mortgage. Is that a concern, or does that help efficiency, or do you just have general thoughts?
So, I think there are these big conglomerates. So like JP Morgan Chase and Company does a lot of different things. There are more niche institutions that do just one thing. Like I don't know anybody has a mortgage from BlackRock, mostly because I'm very confident they don't make mortgages. So there are, certainly in the corporate space, in terms of making loans to companies, I think there's pretty good evidence that we have in the finance literature that there are benefits from having these relationships between the lender and the borrower, because then the bank has better information about what the company is like and about the risk profile, and they're more willing to fund them in a more efficient way, so that's a good thing. I think realistically on the consumer financing side, perhaps in part because of the elaborate regulatory apparatus that has reasons, there's reasons it's there, but one consequence is that it's all very cookie cutter. Right? So you go to a bank, you ask for a mortgage, you are going through a process, and there's almost no scope to tailor that and make it kind of individualized. So we're very far from that It's a Wonderful Life kind of world where the banker knew the borrower. And that, there's many reasons that happened, but one of them is, it's just really, really hard. We have a lot of rules that we have to follow, and that's one of those trade-offs that we can talk about, right? Having more rules protects people, but it also limits what people can do in a way that might be inefficient and potentially, not worth the cost.
Well, thank you very much.